Hey, do you want to know what actual deal analysis looks like when you're looking for a business to buy? Well, in today's video, I'm going to give you a peek behind the scenes on how I use my deal analyzer tool to run any business that I'm evaluating for my clients. So what we're going to do is we're going to take all the information from the business for sale, run it through the deal analyzer, and at the end, it's going to give us the debt service coverage ratio, post-debt service cash flow, cash on cash return, and cap rate if there's real estate involved. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase or diversify your wealth by buying a profitable business, or a W-2 employer or working executive looking to leave the rat race behind by purchasing a profitable business, you are in the right place. Please subscribe to my channel and don't forget to hit the bell. You'll be notified every Thursday when new videos come out. Hey everybody, thank you so much for tuning and watching this video. Glad you're here. As I said at the outset, deal analysis is really one of the most crucial parts of business acquisition. You don't get this part right, nothing else will work. The letter of intent will not be right. Certainly the offer will not be right. You will not know exactly what a good deal looks like until you know you've done the work. So this is a tool that I use inside of my group, my mastermind. And what I'll do is I'll run you through this kind of a mock scenario and tell you how all the different parts work and what you need to be looking at. So on the left-hand side, column B, here, you got the asking price from the listing, the revenue from the listing, and you got the seller discretionary earnings or cash flow that is given to you by the seller or the listing agent that you probably found in their seller on the customer information, the confidential information memorandum, the CIM or the CVR. This is automatically calculated. It tells you that at 400,000, it's 3.5 times seller discretionary earnings, so at 1.4. So if this was 1.2, it would be 3 times. If this is 1.5 million, it's 3.75. All the numbers change. The areas in blue are the input areas, so there's no risk of endangering anything else because all the formulas are protected. Back to this. So we're saying that this is a 1.4 million with $400,000 worth of SDE. So we're right out of the gate, we're looking at a 3.5 times SDE multiple for this business we're looking at. It could be a service business. Actually, let me take a look. This business has no COGS. So this is a service business. So we'll get to the other tabs in a minute. So the financing piece, this is what is given to you by the listing agent. So if this deal has been pre-approved by an SBA loan, say at 15%, it'll go here, which means that you would have to come up with 15% or $210,000 for down payment. And the bank loan at 85% loan to value would be $1,190,000 with an annual debt service coverage ratio of $192,000. I'll show you what that looks like on the other end. Debt service coverage ratio right out of the gate is 2.08. If you notice this cell right here, 2.08, and the annual cash flow after debt service is 207. Our cash on cash return, the 210 is 98.7, not bad. And our cap rate, if it was real estate involved, is 28.6. There's no real estate, so really cap rate doesn't apply to this deal. What I teach my students is you gotta know your industry average SDE multiples. And there are places to go where you can learn that, both for seller discretionary earnings on row 20 and the adjusted EBITDA multiple for if businesses that are trading for multiples of EBITDA. Now, sometimes you hear people say, hey, so long as it trades for 3 times SDE, you'll be fine. Not necessarily, because it really depends on the industry. Valuations are industry specific. So what a 2 times SDE multiple may be acceptable in some industries. In some other industries, you can't compete unless you're offering 4 to 5 times SDE, depending on the industry. So it's industry sensitive. I think a lot of people say 3 times SDE multiple is good if there's lending involved, maybe. lenders will just want to make sure that the deal cash flow is at 2 times SDE versus this, and this is 3.5 times, which is a very, very profitable business. Our offer multiple here is what we decide we want to offer. In this particular case, we decided to offer 2.5 times. Why we decided that? There's a myriad of reasons why, but this is an example. This is a scenario. Say we wanted to offer 3, our offer would be at 1.2 million, as you can see here from column E, 1.2, but we're going to leave it at 3.5 times. So 1.4 to match it. Okay, so this is what matches it, right? So, sorry, we had it at 2.5 times, so $1 million. So how we got there, we'll get to that in a minute. The interest rate on seller carry, it's, it could be anything. It can be higher than the SBA loan. It could be 7%, 8%, depending on what makes sense for cash flow. Notice that this deal has no seller financing option. If it did have seller financing option and say the seller was willing to carry 10%, you will put it here. So in this scenario, you have 15% down payment, 10% seller carry, and 75% loan to value on a bank loan or an SBA loan. Debt service coverage just went down a little bit, but now you have $34,000 a year at 8% over 60 months. Sometimes the lenders will say it has to go with the term of the amortization of the loan. If there is no real estate, it's 10 years. So say we want to make it over 10 years, our annual debt service load goes down and our debt service coverage ratio goes up. Notice everything, you got to interact with the variables, see what makes more sense. So again, we haven't really done any of our analysis yet. This is what is given to us by the listing agent, okay? Assuming that this business is represented by a broker or FSBO if it is for sale by business owner. All right, how do we get to the 3-year average SDE and the average revenue? For that, we go to the operating cash flow or operating concern on the cash flow side. So these numbers represent tax returns for the trailing years 19, 20, 21, and 22 with the interim financials through June for 2023. It tells you here where it comes from. So if you got all the tax returns, assuming this was a corporation, you would either had an 1120S for a small corporation or 1120 for a C corporation. Let's say that the numbers were, $1 million, and this the G&A expense and the officer comp and all of that was this total expenses, and you get your net profit, which should tie to the tax returns. That's the whole exercise. Any lender is going to always lean on tax returns for preceding years except the current year. The cash flow on this deal at $270,000 includes some adjustments to cash flow, which you can see at the bottom. So there was officer comp of $50,000 that got added back, and it got added back at every year. All of your add backs, whether positive or negative, would be at the bottom here. So in this case, the only add back is the the officer compensation, which is actually here in the tax returns, assuming there was a line for officer comp in the tax returns. So, and that's how you populate this information that is here. You take it from the tax returns, you superimpose it here, and we are looking for trending. We are looking to see what the net profit is for the tax returns, what the G&A is, if there is any COGS, what the percentages are, because there are no cost of goods sold, and this is a service business. You can see the trending. So revenue went from 1 million in 19 to 1,250,000 in 2020, 1.4 in 21, 1.5. Nice trending. I like where this business is going. And for the first 6 months of the year, you're looking at $800,000, so it's on a run rate of about 1.6. So the numbers seem to be going up, flowing nicely. Notice the net profit at 22%. It's trending at 32%. So I like where this business is going. This information, less the proposed loan debt service, comes from this other section of the use of proceeds, which I'm going to show you in a minute.
Do you want to know what it's like working with me and my team? I love to know where you are in your business acquisition journey and see if it makes sense for us to work together. All you have to do is drop me a comment below or email me and let's connect.
This is how you start to formulate the whole exercises to figure out what the debt service would have been for any of the preceding years all the way up to the present to see if this is a good risk for the lender. We're only evaluating right now cash flow over debt service. And the definition of cash flow could be net profit by seller plus all of the add-backs to lead to seller discretionary earnings. If it was adjusted EBITDA, it would be seller discretionary earnings minus the GM salary or the office owner comp that is coming in, assuming that you are coming in and you're going to be managing the business. So notice the debt service coverage ratio without a stress and with stress: 1.8, 2.3, 2.67, 2.77, 3.74. With stress, which is what lenders do when they add a couple of points to the loan to see how it would behave if it had a higher debt service: 1.66, 2.12, 2.46, 2.55, 3.45. So far, great. It's a great cash flowing business. Now, where did it all comes from? Where our assumptions are that right now our prime index or our current index, our base for prime rate is 8.25. There's a margin on 2.25. Could the rate be lower? Absolutely. You know, I've seen SBA lenders doing 8.99 fixed, not variable. An SBA loan without any real estate would always be 10-year amortization. So now we're looking at the debt service and all the engine working on calculating monthly payments and annual payments. This is anything that in blue you can enter. Everything else, it's already formulas. Right now, the SBA has a no guarantee through now until September, October in 2024 that there is no guarantee fees. So this will go away for this particular scenario because in this case it's a loan for $1 million. So it's actually a loan amount of $900,000. So how did we get here? Let's go back to the front end. All right, so this is the cash flow that is given to us. In this exercise, the average 3-year cash flow is 386. So you have a choice. Do you go by the 3-year average or do you go by the most recent year? We are assuming that whenever you're looking at the cash flow, usually brokers will put in the most recent fiscal year and close. So this is the assumption that 1.4 million revenue and 400,000 in SDE was what was in the 2022 tax returns. But if you want to be a savvy buyer and don't take the 1 year that they give you, 2022, but you're going to average 3 years, then you came up with 386. It tells me that this business is very consistent. So say we wanted to go for the 3-year average, then you're looking at, if you want to offer 2.5 times 386, that gives you 966. Now, but the seller discretionary at offer is what you think you're willing to pay. What do you believe, per your research, the SDE is worth at offer? So you have two levers. You got your offer at multiple and you're at the SDE at offer. So say that the industry multiple average SDE multiple for this industry was 2 to 3 times. So it was, say it was 2 to 3.5 times. And you knew that you wanted to be aggressive in your pricing and hope for some type of counter offer, and you wanted to offer 2 and you went with a 386. What happens to our offer? Went down to 773. They won 1.4 million. Now, one thing that you got to be careful is when you're negotiating that you don't offend the seller with such a low ball offer that you're really not in competition. If I am representing the seller and I want asking price of 1.4 for a bunch of reasons, maybe the business has been, maybe this business has been around for 30 years with a very successful and robust website, a cash machine for 20 years, and even at 3.5 times, I think is fair. The business has no debt, it's debt free. You're buying the asset, you're not buying the stock, and all of those things. I think it would be insulting if you came out at 2 times and then try to offer me half to the seller of what I think the business is worth. So you got to proceed with caution. You know, for it to be a deal, both parties have to lose something to win something. So even if you go, say if you go at asking price, No, right now at 3 times, our value went up to 1.1 based on the 386. Assuming that you go with the SBA only requires 10%, but in some of you guys have been asking me, wait a minute, what about I have no money to put down? I have $100,000, but I'd rather save it for post-closing liquidity. What if we got the seller to carry 10%? I put nothing. And what would it look like? Well, because this is such a very profitable business, you could conceptually put 0 down per new SBA rules, let the seller carry 10% at 116, buy the business with a loan of $1,044,000 with a debt service coverage ratio of 2. Notice that, 2.09. Post debt service cash flow of 209. There's no cash on cash return because you haven't put any money. Notice how this month changed. So if we actually went to put 10% down, now you have 189.9% cash on cash return. This is a great deal no matter which way you look at it. So $220,000 worth of post debt service cash flow. How good is that? Is that legit? It happens all the time. So say you wanted to go with whatever they're saying the business is worth, which is what we have, 1.96 and 1.99. And the difference between the two scenarios, it's really only $3,400. So this is how you do analysis. This is how you figure out. Now, this right here, the stress test, I always want to know, hey, if the worst thing happened and you bought the business and the business declines over time, what is the minimum revenue and net profit that you need to have in your business on any given year to meet the post debt service requirements, or at least the debt service payment, principal and interest. So your yearly debt service, on this case, let's go back to no seller carry, and you're putting 10% down. So $197,000 per year of post debt service at basically 10.5. What if the rate was lower? So if we got a better rate, so 7.25. Now our rate is 9.5. What happened to our debt service? Went down from 197 to 189. This is how you play with the different variables. Now, I need to cover 189,000. So say you did 900,000 worth of revenue. Notice that the SDE per seller is 26.7. This is your net profit, and your SDE offer is 25.8. We know that the business is considerably more profitable than what we were anticipating. But say something bad happened, and you need to figure out what is your fallback position. If a business did, 900,000 in revenue, and you have 10% net profit, you still cannot cover, right? So if you did 15% net profit, okay, say what that $1 million here, and 15%, 17%, 18%, 19%. Okay, you would have to generate $1 million at 19% net profit to be able to break even on the debt service coverage ratio. But if you were to buy a business just for the sake of breaking even, why are you buying a business, right? This is what you need to be looking at when you're analyzing any deals. What is the debt service coverage ratio? What is the annual post-debt service cash flow? What is the cash on cash return for you? And what is the cap rate if there's real estate involved? There are other sheets here that we haven't even begun to analyze. This is a very robust workbook, but this is kind of how we do deal analysis inside our group. Hopefully this video was helpful to you. Please comment below. Let me know what you think.
For a limited time, I'm giving away my cash flow calculator workbook, the very same tool that we use today to analyze deals. It's been downloaded over a couple thousand times over the last few months. It's a great tool for all the things that we talked about in today's video. It is yours to keep. All you have to do is click on the link below to download it.